Okay, so today we're going to be talking about financial management. This is coming by way of the Department of HUD and Urban Development. At one point, they had this partnership center in which they work with folks in the neighborhood to build capacity. I'm using this model right here because I think it's the best way to talk about financial management. So, Charles, let me ask you a question without even going into this material. When you think of financial management, what do you think they're talking about?
How you keep records and manage the income and the revenue that's coming into your business?
Good. In a nutshell, that's exactly what it is. How do you manage the money? Okay, let's continue on. Okay, let's give a shout out Department of Urban Housing and Urban Development. This is coming out of that Center for Faith-Based and Neighborhood Partnerships. Again, this was written a while back, but the information was developed. Some of the things we're going to be talking about in this section is financial management and budgeting for nonprofit corporations. Read that first paragraph here for me.
Managing financial records is critically important for the long-term health and sustainability of any nonprofit organization. For a nonprofit, long-term stability means having the ability to meet financial obligations such as payroll, rent, the cost of implementing and maintaining programs, etc. An organization's financial transactions must be appropriately recorded and maintained. An analysis of all financial data should yield information that will help guide the organization and allow it to properly plan for current and future activities.
It is so important that an organization understands if you can't manage the financing, not only can you lose funding, but in a lot of cases, because you mismanage, you could go to jail.
Yes.
So we're going to be talking about some key tasks. One is to develop and maintain a system for recording financial transactions. Next, determine and track the funds needed to operate. You have to track your funds and know if you have enough money to pay your folks or to keep the rent on. To properly allot funds to specific programs. It's important because sometimes people will get multi-grants and they throw all the grants into one bank account. When in actuality, they should separate each bank account with the grant that you receive. If you receive 6 different grants, 6 different bank accounts in order to manage it. Manage the organization cash flow. Cash flow is king. If you don't have cash flow, you don't what? If you don't have cash flow, what?
You ain't got cash flow, then your business is in trouble.
Okay, if you ain't there, you can't pay nobody.
Ain't pay nobody, you in trouble.
Exactly. And you have to pay your debt. And then you have to manage assets and inventory. So some of the questions you want to ask yourself, and we're not going to ask the question today, is to list some key tasks associated with your financial management of your organization. Okay, let's continue on. And read financial activities for me.
Transaction handling and record keeping. Timely and accurate billing for services performed. Timely and accurate payment of goods and services. Prompt deposit and receipts. Proper authorization of payments. Proper recording of transactions. Timely and accurate preparation of financial reports.
All of these are key components to transaction handling and record keeping. Record keeping is all about keeping record of how money was spent, what it was spent, where the money is coming from, all those things. Now, when you talk about financial activity, there are three key things that we're going to be talking about. First is transaction handling and bookkeeping, and then planning and budgeting. Both of these go together. You plan and then you budget. And then the last thing, we'll go back to financial management. Let's continue. Okay, read this for me again.
Transaction handling and record keeping are the bookkeeping and accounting areas of financial activity. Checks must be written to pay bills. Incoming payments must be deposited. Records of transactions must be kept.
One good way of keeping a handle on your financial is a software. I think we talked about it. What's the name of that software? Because I have it. QuickBooks.
Mhm.
Exactly. QuickBooks is a good financial management tool to use. And that QuickBook will prepare all this stuff right here.
Mhm.
QuickBook can prepare this for you once you put in the information.
Wow.
Okay, let's continue. Now, talk about planning and budgeting.
Planning and budgeting. Planning and budgeting are processes in which organizations set goals and objectives, choose programs, and decides how those programs will be operated. The budgeting process relies on both financial information about past performance and the organization's future plans. In this area, your organization should be concerned with.
Exactly. I think that then goes to some of the key components related to financial activity. Make sure you involve people who can assist you with the budget process. Consider both external and internal factors in the budget process. If you can, use past and current information to develop a realistic projections. Gain understanding and support as to how the budget will shape your decision making. That's very important. So when you create a program, not only you have to talk about what the program look like, then you got to break down the budget as to what does the program cost.
Mhm.
Okay, read this first paragraph here.
There are a number of things an organization must consider as it establishes or grows its fiscal office. You will need to decide who will be the keeper of the records. Should you hire a bookkeeper? Should you contact with an outside organization for things such as payroll? Should the executive director also serve as the fiscal officer? Will you need to have an audit?
Now, it's a no-no for the executive director or CEO to also serve as the financial officer. Because there's no checks and balance if you do it like that. So definitely you want to make sure that the executive director and the financial officer is separate from each other. Always make sure you do an audit. An audit probably should be done in year 2 that you bring in money. An audit can be internal as well as external. Always have on board an accountant. You don't need that accountant for a full-time job, because basically you got your software that you use by way of QuickBooks. But the accountant will validate the information that you're putting together. We're going to talk about that later when we talk about reconciliation and all that stuff like that, how that's relevant. Okay, read for me program planning, this side of the table, right here.
Program planning is often viewed as the job of the director or the program directors and the board. Fiscal management is usually assigned to the bookkeeper, accounting personnel, and maybe the board treasurer. At times, fiscal staffs view program planners as unable to understand how their decisions can place undue strain on the organization's bottom line.
Now read for me a program planner and a fiscal manager.
Program planners concerned with ensuring a particular service is provided, how and which clients are served, how the board and the director will support the service, etc. Fiscal managers concerned with the cost of the service, the impact a program has on existing resources, how new requirements will impact staff, or how the timing of expenditures and receipts will impact cash flow.
So
etc.
at the end of the day, the fiscal manager is all about the money. Whereas the program planner is the person that's putting together to provide the service. The fiscal manager is there to say, can we afford this?
Yeah.
So that's why that balance is there. Okay, let's move forward. Okay, so do me a favor and read this here.
Program planners may feel the fiscal managers do not understand how important it is for a program to continue or expand because of its fulfilling the mission. Budgets.
Excellent.
What do you want me to?
Yeah, continue on here.
Okay, budgets are tools of the financial management system used for two central management functions: decision-making and monitoring and controlling.
Read that again.
Budgets are tools of financial management system used for two central management functions. Number one, decision-making, and number two, monitoring and controlling.
Yeah, and it's so important. Let's talk about monitoring and control function. One thing is it compares revenues to expenditures. It allows and ensures adjustments are made to program if the financial situation changes. It illustrates the need of the organization to others, and it addresses compliance requirements of the different funding sources. Read this last one right here.
Addresses compliances requirements of different funding sources.
Every time you go for a grant, that grant is going to have what's known as compliance requirements. You always have to adhere to those financial requirements. For example, they're going to want you to do an audit. They might want you to make quarterly financial reports. Nevertheless, you always must show you address the compliance requirements of each grant individually. Okay, let's continue on. Okay, sum it on up.
Summary. Budgets define goals for a given period of time. Monitor progress throughout that period of time. Provide information on whether fiscal goals for a particular program are being met to allow adjustments to be made. Predicts and monitors the cash flow of the organization. Provides information to funders to gain their support.
Exactly. Provide information to funders to gain their support. That's the budget. Now let's move to the next. The budget process. How do we create a budget? What are the 10 steps involved engaged in doing a budget? The budget process, like I said, it's complex, but it can be simplified. Especially with you taking this training, you simplify it. The different folks in the organization that you might want to include on the budget is the executive director, the program director, financial staff, they deal with the money, like your accountant, for example, and your other people. financial committee members. For example, normally if you got a board of directors, you're gonna have a finance committee. That committee or someone from that committee should be there, as well as the board treasurer. Now, this is ideally, for most times, a small organization, it's simply the executive director that's putting together the budget. But ideally, it would consist of all of these individuals right here. That being said, let's start to talk about the different 10 steps in putting together a budget. Start with here, step 1.
Step 1, set framework. Establish the budget period and review program achievements and financial performance for the period. Same as accounting year, whenever possible. Review prior year's performance and achievements.
That becomes the first process in setting the framework. Step 2.
Step 2, set goals. It's budgeting. Set goals and activities. Identify major programs and activities of the organization and set goals and objectives for the budget period.
And read step 2 over here.
Identifying major programs and activities and setting the goal and objectives for the budget period is one of the most important activities necessary for sound budgeting. The major program. I'm sorry.
Here we go. Continue.
Oh, the major programs and activities identified should be the same as those used by the accounting department used to generate financial reports.
So that means that everybody that is related to finance must be using the same type of software. So everything is consistent. But another thing that caught my eye related to this is that one of the most important activities necessary for a sound budget is making sure you got those major program goals and objectives. Okay, let's continue. As you know, I'm going to go over, I'm going to bypass some stuff because I'm going to give it to you to read at your leisure. Let's go back up here. We're on step, did we? Yeah, we're on step 2 now. We read step 2, is that correct?
Yes, sir.
Let's go to step 3. Okay, read step 3 for me.
Allocate cost. Decide on the method of cost allocation and estimate the cost of required resources or expenses. In estimating the cost of required resources, the organization must not only determine the direct cost of running the program, but it should also determine the shared or indirect costs, such as rent, phones, accounting, etc.
When you're creating a budget, there's 2 types of major budget items. One is direct and the other is indirect. That being said, read this here for me, step 3.
Up here?
Yeah, right
here. Step 3 of the budgeting process requires a determination as to how to estimate how to pay for the indirect costs not directly identifiable to a specific program activity will be paid for. The federal government defines indirect costs as the costs incurred for a common purpose and therefore benefiting more than one organization's activities, cost, or objective, and not readily attributable to specific activities without an excessive level of effort. Typical indirect costs include depreciation or use allowances on buildings and equipment, cost of operating and maintaining facilities, general administrative expenses such as the salaries of executive officers,
Yeah, for sure. Indirect costs is any cost that's not associated with providing direct services. What does that mean? Well, direct services will be the clientele that you're serving. You're helping them produce video. So whoever that person is that's training them, that's considered to be part of what's known as a direct cost, because it's actually providing the service to the client. Indirect costs are those costs necessary for the organization to run. An accountant. Well, the accountant doesn't really do anything with the client other than the organization. A lawyer. Well, a lawyer doesn't do anything for the clients other than protect the organization. So that's what we mean by indirect costs.
Yes, sir.
Those costs associated with actually administrating that program. That's why cost allotment is very important. You need to make sure you allot the cost to either direct or indirect. And a lot of times we make a mistake by putting the money in the different categories as it should be. Talk about estimate revenue. Estimate revenue.
Estimate anticipated revenue. Just as an organization must evaluate its planned expenses, it must also evaluate planned revenues, historic information, the experience of others, and understanding current economic conditions are useful in this process. It is always best to err in the direction of a very conservative estimate when the source is highly competitive, unknown, or if a funder is undergoing change.
Yeah, all those things need to be taken into consideration when you're estimating your budget. But a lot of times, if you do your proper search, you can match yourself up with the proper funder that's going to give you the anticipated budget that you need. Make the realistic assessment as possible of anticipating revenue. Some people will say, we're going to bring in $1 million, but how you know you're going to bring in $1 million? If you ain't got a letter of intent, or if you ain't working with an organization that you have identified as a funder, it's not a realistic assessment. Make sure that you, remember, what did we talk about? Do you recall what we talked about last week? God, I can't even remember what we talked about last week.
Hold on, I took
What did we talk about last week?
We talked about.
Searching for the grant, right?
Yes, sir.
Okay, that's how you determine future revenue. You look for and make sure you got a grantor that you can match with that can actually fund the particular program. That's what they mean by make realistic assessment of any anticipated revenue. And you do that by searching for funders and matching those funders with the program. That's one of the ways that you do that. Okay, excellent. Yeah, read this right here for me. I find that interesting what they say.
Making the most realistic assessment as possible of anticipated revenue. It could also be useful to develop a contingency budget to address what if scenarios. However, it is difficult to develop such plans if large chunks of revenue come from a few sources, such as government, foundations, or corporations.
And this is true. That's why we talked yesterday or the last time that that's over 100,000 funders and foundations.
Mm-hmm.
And if you got that type of resource, then you're not talking about a free government or foundation. You have access to all that. You increase your chances of getting that money. That's why it's important that you understand who's funding, where they're funding, and what they fund for to make a realistic business. And that's why these classes become so important, because you know you can't wish for money. You got to actually search for the money and match yourself up with the funding. Yes. A lot of organizations wish for money. Well, we know we're doing a good thing. I know we're going to get at least $1 million. But they only talk about where they're going to get that $1 million from. and wishing and getting. All right, let's
Got it,
continue.
sir.
Now, adjustments. Talk about adjustments.
Adjustments. Make necessary adjustments to bring estimated revenues and expenses into desirable relationship. Once the estimates have been made, it can determine if the budget will balance or whether revenue or expenses exceed the other.
Adjustments are important because first your numbers that you kick out for what you want might not match the amount of the grant. In that case, you're gonna have to relook at the program and say, what can we reduce, adjust in order to meet the total budget that we're going for.
Mhm.
Now, let's go to step 6. Read step 6. Probably one of the most important steps.
Cash flow. Prepare a cash flow projection and plan for cash flow as cash reserves.
Excellent. Now read this right here for step 6 so we can get in depth.
A
This
cash
is so
flow,
important. That's why I'm saying we have to read the whole thing. Cash
Yes, sir.
flow is king.
a cash flow projection involves projecting monthly cash coming into the organization and cash going out. For an example, even if the organization has a balanced budget, it may not receive revenue until the end of the budget period, while expenses are spreading throughout the period. A cash flow projection will help foresee cash flow problems and plan for solutions. If cash flow problems appear to be an ongoing problem, you may consider setting aside funds into a cash reserve. This will ensure there are adequate funds to cover expenses while waiting for revenue.
We're going to actually, not this week, next week, actually look at what does a cash flow budget look like. And then learn the terminology to put together a cash flow budget. Okay, we made it through this. We made it all the way up to cash flow. Now, approval. Read about the approval.
Approval. Approve the budget done by the board of the organization.
Okay, read 8.
The board approves the budget as a part of the governing function. Step 8, the executive director may determine if program managers have responsibility for monitoring and controlling the expenditures for a program.
For any budget that comes through a nonprofit, the board of directors must give its final approval. Once that board of directors gives its final approval, in step 8, the director is responsible for implementation. Implementation of the plan and the budget. The director will tell us upon which staff is responsible for implementing the plan and the budget. So step 7 is that it must be approved by the directors, and step 8 is implementation. So that's it, okay?
Yes, sir.
No, it's not.
No.
Let's go to step 9.
Step 9, monitoring. Compare revenue and expenses to the actual budget. Report on expenses and revenues should be done in a timely, ongoing manner, and such reports should be distributed to those with budget control responsibility, such as the executive director, the treasurer, board members, etc. Ensure the financial reports are done monthly and provided to management and the board. This ensures that programs are on track and will indicate if there is a financial situation that needs attention.
Now read step 10.
Okay. Oh. Okay. Step 10 is amendments.
Right,
Update cash
exactly.
flow and revise
Minutes,
plan budget.
update cash flow. Let me tell you why it's so important to monitor the budget. Let's say you budget for 6 computers for 1,200.
Mhm,
By the time you got the money, the computers are 1,500.
mhm.
So you have to monitor it because you know you're limited in what you can pay for. So that means you have to go in that budget and say, what can we take and make up for this cost that we didn't anticipate? That's why it's so important that you monitor the budget throughout the whole process to make sure that you have control over costs. Because you might have put in one thing, put office space. Let's say another example. Let's say you budget in for 1,200 a month for these landlords, ran up, and now instead of 1,200, it's 800, 1,800. That's why we mean by monitoring to make sure you're looking at the budget. That's why you try to have some cash reserves if you can, but you always monitoring that budget. Because if you don't pay attention, you're gonna get what from the bank? Insufficient notice. And so we call it insufficient cash.
Mhm, mhm.
A lot of organizations get the money, but they don't monitor it. You have to monitor that money because changes will all come about. I don't care what cost you think you got locked in, things changes.
Yes, sir.
It definitely changes. So you have to allow for that when you looking at the budget to put in that process. And that's what funders want to see. How you going to monitor it? Well, we're going to get a red flag anytime some cost is going over or under. We're going to get a red flag to go in and resolve that immediately. Okay, so far so good.
Yes, sir.
This is bars. Read this and then read this. Let's start
More
here.
about cash flow. Cash flow refers to the need to have cash come in at the right time to meet expenses. Cash flow can be projected, monitored, and controlled.
All right.
Cash
Excellent.
flow. If an organization has more expenses than income, sooner or later, it will be in trouble. An organization can also be in trouble when it has more income than expenses. This occurs if the income and expense occurs at different times, so that there is not enough cash to cover the debt.
Yeah, man, this is something that you need to watch out for. It doesn't happen that rare, but it does happen. That's why you got to monitor that cash flow to make sure that you're constantly on top of those expenditures. You do not want expenditures or expenses to be more than income,
Mhm.
because then you got problems. You're in the red, and you'll be surprised at the number of corporations and organizations that go in the red, only because they was not paying attention. They were so happy they got that grant. They was jumping around, and they didn't understand. That's the easy part, getting it. Now we need to monitor it from day one to the end. Okay, read about addressing cash flow problem shortages.
Addressing cash flow problems. Loans, line of credit, required fees to be paid in advance, speeding up collection and receivables, change the timing of fundraising events, working with funders for a more favorable payment schedule, delaying payments to vendors, liquidate investments.
Oh man, these are some options that you have, but you try not to delay payment or you try not to delay investments. Liquidate investment. Try talking to the funder, letting them know what the situation is. If necessary, take a loan out. For example, You could go to a bank and ask for a loan line of credit. And look, they might kick it because you're a nonprofit 1%. That's unheard of. Money make money. But you use this only when you need to. Banks will give you a loan if you got a letter of intent from a funder, a letter of intent from the funder that you're going to be funded for a certain period of time. So that letter of intent and that award letter, they will give you, money, for example, to help pay, help keep the cash flow going on.
Gotcha.
Okay, let's continue on. Now, let's talk about surplus.
Addressing cash flow problems, surpluses. Surpluses may appear to be a good thing, and yes, they are better than shortages. They're short-term investment, change the timing of fundraising events or campaigns, make loans, buy supplies on sale that are not immediately needed.
Right, that's another good thing about surpluses. Go to some place and get things cheap that you know you're gonna need. Toilet paper, every organization needs toilet paper.
Yes.
And that's just one example of buying supply, getting ink pens in bulk. Buying 1,000 at a time instead of 100.
Yes.
So you're constantly trying to get surpluses or items to use now for what you're going to need for in the future. So you definitely want to address cash flow problems in terms of surpluses as well. Making loans, I wouldn't suggest a nonprofit make loans.
Right.
Some do. In certain situations when they're doing. One example of making a loan would be a nonprofit that's doing business development and small business loan. And was they getting money in that they loan to the potential business, and that business is paid back in a low interest loan. Again, that's one. That's, I know we're using those strategies in terms of doing our business incubator and our business center as one of the strategies when people come in for a micro loan to have those dollars for that type of situation. But normally you don't make loans. Okay, that's it. Nope, not yet. Read about internal control system. This is so important. And don't read all this right here. Let's go down and read this, and then read these different safeguards. So start here.
Okay, internal controls safeguard the organization's resources and work to ensure that an organization's plan and policies are implemented and decided upon. Internal controls are needed to provide reliable data, safeguard assets and records, promote operational efficiency, encourage adherence to prescribed policies.
We don't really have to read all this. Let me give a quick summary. Provide reliable data, making sure the information you got is reliable. It's the real numbers. It's not inflated numbers. Safeguard assets and records. Don't have a situation where board members can take computers home to work on. That must stay in the organization. Safeguard it. Safeguard it, meaning if you got petty cash, make sure employees are not taking from that petty cash to use it for themselves. That's what we mean by safeguards.
Yes,
making sure those records are protected. Make sure your accountant is not writing 2 checks to himself or something like that. That's what we mean by safeguard. And then you want to promote operational efficiency and encourage our hands to prescribe policies and procedures. That's most important, having a financial management for financial policies and procedures, because that manual for financial procedures and policies will dictate how everything is done, including making sure that every time a check is written, it's signed by 2 people. That's
yes,
appointed by the board. which is normally the CEO and someone else that's on the board or someone else. Okay, let's continue on. Let's talk about a minimum of self-control.
A minimal set of controls might include an accounting procedures manual.
Talked about that earlier, right? You need a manual. Some call it financial, some call it accounting.
2 signature authority for payments.
We talked about that. You need at least 2 people to sign. If one person signs, they can rob you blindly.
Yes, sir. Bank reconciliation review by someone other than the bookkeeper.
Bank affiliation is normally every time the board meets. The accountant, normally the accountant, will give a reconciliation of the bank statement and say what everything was used for that month. And explain anything that's out of the ordinary. It's called a bank reconciliation. To make sure you're looking over everything on that bank statement to make sure nothing is wrong. And the treasurer normally does that with the accountant or the bookkeeper. Next.
The board of directors should approve the annual budget and regularly review financial statements.
Every year, the executive director or the CEO must present to the board of directors a budget for that particular year. Programs, the whole 9 yards. And the board must approve it. In addition to that, you must review those financial statements every month. You can do that through bank reconciliation. Next.
The board should approve leases, loan agreements, grant proposals, and any major commitments of the organization.
You cannot do anything that's involving a legal responsibility of your corporation if the board doesn't approve. If you're going for a grant, there must be a meeting, and a meeting must say the board met to approve the corporation to go for such and such grant. If you want to make a loan, the board must approve you doing that. So the board must approve everything related to any major commitment of the organization. And then finally,
the board should approve personnel policies.
Now, while the boards approve it, it's up to the CEO to create it.
Gotcha.
Normally, the CEO or the executive director is the person that's approved. Okay. All right. Let's read this and read this. But before we do, every organization should have an audit. An audit is when a person from the outside come in and they look at your books to make sure everything evens up. They might find that, hey, hold up, you got $37 here in this account, but yet over here you got 35. You got 37 over here, you got 35 over here. So there's something wrong with this, and we need to, make sense of this. That's just an example. An audit will make sure everything to the penny is explained. And it's an outside source to come in, and they actually have to sign up on it, saying that they stand behind their report. All right, that being said, first read audit trail. No, first read this, and then we'll go to this and this.
Okay. Financial reports are used by people within organizations and by people outside the organization. Accounting standards that are used by all organizations in external reports share a common language to ensure understanding and to make it possible to compare the finances of one organization to those of another. Audit trails. The system of internal controls provides an audit trail. An audit trail means that a transaction, deposit, payment, etc., can be followed from one end of the accounting system to the other, e.g., from the source of origin to the financial record, or from the financial record to the source of origin.
This is so important. That language right there. Everything must connect. Give an example.
For example, from a source document such as a supply order, the auditor should be able to trace how the transaction ended up in the financial statement. Similarly, the auditor can trace any item on the financial statement back to the source documents to verify the nature of the transaction.
Everything must connect. When you buy something, it must connect. When was it bought? Where the money coming from? All that stuff must connect. That's what that auditor does. The auditor, third person comes in to make sure that your books are legit and you're not, what they used to say, cooking the books. Some organizations got one set of books and then they have a other set of books, right?
Yeah.
That's a no-no. That's a no-no. Okay, let's continue. Okay. When is an audit needed related to the feds?
The federal government requires independent audits only for organizations that have expended more than $300,000 in federal funds within 1 year. Government agencies may require a government or independent audit for contractors. Some foundations may also require audits of grantees. Nonprofits that expend $300,000 or more per year in federal funds, whether direct or indirect, must have an A-133 audit.
A-133 audit. That's when you know you in the big time.
In there.
That's what kicks in the an A-133 audit is the most in-depth audit. It goes all the way down. You know, all the way down. It finds things that a general audit wouldn't find. So it goes all the way down. So whenever a nonprofit is 300,000 or more, that's when that audit kicks in. I always tell nonprofit, act as if they're doing an A-130 on you, although you don't meet those requirements. Mm-hmm. That way, when you have to do an A-133, you're used to it.
Used to it. Mm-hmm.
So you don't have to get acclimated to it. Let's talk about a single audit.
A-133 single audit. The auditor's objective for an A-133 single audit, in addition to the expression of an opinion of the financial positions, are to determine if the organization has an internal control structure that provides reasonable assurance of compliance of laws and regulations, not only at the financial statement level, but also with regard to program management. The organization has complied with the laws and regulations that may have a direct material effect on its financial statement and on each major federally funded program.
So as you see, getting a grant is not only getting the grant, but also making sure you stay in compliance.
Yes, sir.
Now, let's read this section. Read this right here.
Accounting reports and audits. Based on the investigation, the auditor issues a formal opinion about the financial reports of the organization. Note.
I'm sorry, go ahead.
Note, an audit is not designed to uncover fraudulent activity within the organization.
That's not true. The feds come in, that's what they try to find, right?
They dig it.
But normally it's not. Normally an audit is an audit. It's your IRS come knocking at your door, right? If they come, it's designed to find fraudulent activities. Other than that, they would be at your door. Anyway, right. That's a side joke. Talk about the different types of audit opinions here.
Audit opinion types: unqualified opinion, qualified opinion, disclaimer of opinion, adverse opinion.
Now, the unqualified opinion would be something where so We was only able to get like 80% of the information we needed, but from what we got, it looks good, but we can't give 100%. A qualified opinion means that we look at everything. And what we found was that the organization was as whatever that follows that. And the disclaimer of opinion, that's when you're saying that, read we read it from here. What is a disclaimer of opinion?
The auditor may issue a disclaimer of opinion if insufficient evidence exists to vouch for the financial statement.
And when would they issue an adverse opinion?
The auditor believes that the financial statements are inaccurate.
You never want this to happen. You never want this to happen. And what you try to do is to bring in your own account. That's why the federal government says no. It has to be a third person, but from the outside to look at your books. Mm-hmm. Your accountant can assist in explaining things, but it must be a third party auditor, and they don't want them to know each other.
Gotcha.
Okay. This is talking about how to engage in getting an auditor. We don't need that. You can read that at your leisure. Now, this is going to be important. Read the first paragraph.
Developing the program and project budget. When developing the budget for a specific program or project, you should consider organizing it based on HUD's SF 424. This standard federal form provides a good guide to help you organize your budget costs into categories.
When you're ever going for a federal grant, you're going to use what's known as SF 424. It's just a federal form. Now, that budget, and this is a budget, that budget is going to consist of personnel, financial benefit, travel, equipment, supplies, contractual, construction, and others. That's how you put that budget together for the SF 424. When you start going for federal grants, they got some serious budgets that you have to complete. But at that point, you at the point where you bring in that type of money, so you can put somebody on board that can tackle that if it's necessary.
Gotcha.
Okay, let's continue. Just read about indirect costs.
Indirect charges. You can only charge this if you have an existing approved indirect cost rate already in place with the federal government.
That you always want to make sure that you want to make sure that you understand what is the standard rate, so that you don't charge too much for your indirect costs. Like they might say 10% of total budget can be attributed to indirect costs. Mm-hmm. So you always want to make sure that you're paying attention. Now, again, this is only for, and this whole conversation today is for federal grants, the high form of budget that you can do. Okay, let's continue on. But it's very important because you can use these strategies for any budget.
Okay.
Then it talks about how you got to build your budget. You break it down, costs include your project director, allocation of money, and the total amount of money, and then fringe benefit, 20%. Now, fringe benefits, 20% to 25% is normally the standard in terms of, first of all, tell me what fringe benefits are?
Other things that's not that you pay your employees, that's not part of the
salary. Exactly.
The salary. Mm-hmm.
Anything that's not part of the salary. Because see here, this is a salary. The fringe benefit is, for example, health insurance, personal leave, holidays, and all that stuff is part of your friend's benefit. And guess what? It's by law, you don't have to have friends benefits. But normally federal government, they want you to have friends benefits.
Okay.
Okay, let's continue on. And then all this stuff is about building the budget. And you can look at this at your leisure. Again, building the budget when it comes to supplies. For example, supplies could be computers, printer, financial software. What's that financial software they talking about?
QuickBooks.
Okay, all right, they even put it in here. They
Wow.
even let you know. You can budget it, you can put it, as long as you call it financial software. I mean, software and not any other type of software. It has to be called financial software. Okay, this gives you some more information concerning key components. The most important when it comes to financing, the OMB is what you need to read. This book is about 40 pages long.
OMB, sir.
You can't go wrong when you're doing your budget and you look at this right here to say, hey, is it in this book right here? If it's in this book right here, you can use it.
Gotcha.
Okay? If it's in, and why is that important? Let's say, for example, you were saying that you want to purchase a computer for $2,000. And the person at the budget office is saying, well, you know, $2,000 is not a much, not a lot of money. I mean, it's too much. You can get one for $1,500. You can go to the NBA, this circle right here, they say in this A1, they say we can't buy a computer that's more than costs normally if we can direct it towards productivity. See, that's what you can use to challenge. And just in case you submit a budget and they say no, you can always use this right here. And guess what? This rules. If you quote this right here, they can only go by this right here because Congress put this together.
Wow. OMB,
okay.
Sir.
And you can go right on to the White House site,
Wow.
whitehouse.gov.omb.
Wow.
Whatever you want to challenge. Now, the other way is cost sharing. Cost sharing is when maybe, read what they said about cost sharing.
Cost sharing, remember to detail the value of all resources that support your program. This includes the value of items such as land. Seek an appraisal for any land or building donated for your program. Volunteer hours. Make sure you establish a process to record volunteer hours so that they may be reflected in your budget. Often local United Way agencies have databases with salary equivalents for various volunteer positions. Costs must pass a reasonable test.
I cannot overemphasize the importance of bringing on volunteers. For example, the federal government allows you to give volunteers, because they're not paid, a $22 hour, $22 per person. And if you write for a grant, and if you write for a grant and you got if you write for the grant and it's $22 and you got 100 people, what's that?
$2,200.
How much again?
$2,200.
$2,200. And if you multiply that, because the average person is going to give 20 hours, what is that? Anyway, you see my point. The numbers begin to go up.
20,000. Yes, sir.
Yes. You see how the number goes up? So that's going to look good in your budget. You requesting 150,000, and in your pro bonus section or your volunteer section, you got 30,000 worth of hours of people commit. So that's how you play it with the volunteers.
Wow.
Okay, again, they talk about, read what they say about in-kind. Read the whole thing.
In-kind services. These can include a wide variety of things, including printing, advertising, marketing, etc. There could be a wide number of people who offer to support your program by providing in-kind services. However, at times, intentioned offers are not always fulfilled. If you are counting on in-kind services, be sure to have the commitment given in writing.
Yes,
Another rule of thumb, whatever is offered, expect to receive only a percentage of the offer and budget accordingly.
definitely. And this goes down to cost sharing. They talk about the accounting rules and the real rules. You can read that at your leisure. Again, more examples of budget. Budget timeline, that's important. That you put together your budget and your timelines as well. Read this section right here.
Where is it? Where? The key terms?
Yes,
Okay, term program income refers to any revenue that the project is expected to generate. Examples might include ticket and program sales at special events, not always treated in the same way. Find out the agency's rules regarding use of program income.
yes, that's very important. Budget consideration.
Make
Read
sure,
what's most important.
check your math.
Check your math.
Make sure
Okay.
that you realistically,
So we're going to be coming out of this. Hold on one second.